Will the Federal Reserve keep raising rates, or will they finally pivot? Now, it's no surprise that the Federal Reserve announced they would start raising rates and start quantitative tightening last year. Since then, the markets have been selling off. Of course, the Federal Reserve is really serious about fighting inflation, or so they say. Getting inflation down from that 9.1% and making serious progress, as they say, on that number. Of course, their only tool is the money printer. They can adjust rates. That's really what they can do. So will they continue to raise rates, or will they pivot? That's what everybody wants to know, and that is the topic of the conversation I am having today with James Lavish. We're going to talk about inflation. Has the inflation, CPI, has that number peaked, or will it go down? What's going to happen with that? We're going to talk about it as the world develops over the next several years and decades, what's going to happen. We'll talk about the European bond crisis that's happening and the potential for the European Union to break apart, like I've been talking about. We'll talk about the Japanese bond environment and what could happen with Japan and Europe and those potential black swan events. We'll talk about, of course, the central bank digital currencies. Is this the government's answer to fighting this problem that they're in? Will they push the CBDC out, and what will that mean? We'll talk about Bitcoin, of course, how that fits into that, and so much more. It was a great conversation with James Lavish, one that I love. We did it in studio, so let's go ahead and just jump right into the conversation. So James, welcome. Welcome to the studio.
Yeah, thanks for having me, man. It's good to be here.
Man, I always hate this part because it goes from just having good casual conversation, and then all of a sudden it switches into this interview mode. I try to oh no, let's save that as we're talking.
It's not an interview; it's just a conversation.
Yeah, and then you can't get back into it. Before we jumped into the actual interview piece, we were talking about this latest piece by Zoltan Pozsar, and you haven't read it, but basically he's saying that the world benefited from globalism through opening up trade, and so we've taken $50,000 jobs in the United States, and now they're $8,000 jobs overseas, and a $100 part now is an $8 part, et cetera. And so we've managed to have this massive deflationary period, but that's all changing. Of course, I've been talking a lot about my 3 cycles thesis is the world is moving from centralization to decentralization, so the same thing. So I agree with his thesis that now as the world decentralizes, we have the reverse of that, which is now re-onshoring everything. And as we re-onshore everything, then things get way more expensive. And so most likely the trend that we've had of globalization and deflation now will reverse, and now we'll have decentralization and more inflation.
Yeah, it makes sense too because it's a good driver to pay down debt. I mean, our world is so it lives on credit, right? So there's so much credit that you have to deflate it away. So that actually works to have inflation. It makes sense.
Yeah. So let's take a second and define inflation for a second, because that's a problem, and I think we're already thinking of different things.
Yeah.
Okay. So I like the Austrian definition of inflation, which is increasing the money supply.
Sure. Yeah.
And when you increase the money supply, then all types of things go wrong, go haywire, because we're in a complex system, and so prices of things move. Today, the prevailing definition of inflation is the price of my coffee
CPI,
went up. CPI, consumer price inflation.
Yeah.
And an economist could be factually correct, but I think it's inaccurate. But they'll tell you that QE isn't inflationary because it didn't cause consumer prices to go up. Yeah, sure, stocks and real estate at all-time highs, but those are assets.
Right.
Those aren't consumer prices. So then they'll start to split these hairs. But I think, again, in the context of what we hear today, CPI, consumer price inflation. So the reason why I don't like that definition is because of what you were just getting into, which is they like inflation to inflate away debt. But there's trillions of prices, and there's trillions of reasons why those prices could get higher. Now, typically they break them down into 2 categories, so cost push or demand pull. And so the demand pull, I would think, is from too much money printing creates too much demand, and so now we're buying too much goods and services. They don't really classify it that way. They classify demand pull as I think people saying, oh, the refrigerator is going to be too expensive in the future, I should buy it now, like anticipation of inflation. I don't know if that's how you understand it.
Yeah, inflation caused by the expansion of money supply, I mean, it can be directly tied to when there are programs that actually get that money into people's pockets, right? So if you listen to Lynn Alden talk about it, she clarifies that, look, if we didn't have all of the programs over the last few years after the lockdowns to get money into people's pockets, then we wouldn't see the inflation we're seeing, especially because, we had supply chain issues and the money got directly into people's savings accounts. The problem is you have the Cantillon effect where you can increase money supply, but it does not trickle down. So some asset prices may rise. You may get the Allianz and Berkshire Hathaways and, BlackRocks buying up homes and raising rents, which is a very large part of CPI. But, getting money into people's pockets is really the driver of money supply expansion creating inflation. So you can look back in periods where the expansion of money supply didn't directly cause inflation right away. Right? So,
but that's the key word, directly.
Yeah.
Directly or indirectly. So I had Jeff Snyder on recently. Super smart guy, understanding the euro dollar market and the inner workings of the central banks, et cetera. Mm-hmm. And we got into that a little bit, directly or indirectly. He says the central banks don't do anything. Well, they didn't do anything directly, but they said they were going to do something which indirectly moved markets, right? So there's like that. But so that's the demand side of the equation. Mm-hmm. And so to that point, we saw that, for example, supply chains were breaking down. We couldn't get stuff in the country fast enough, but we saw that we were ordering 20% more goods than we were before. So supply chains were breaking down because we were ordering more than we were before. But he said that what we saw was an increase on the goods side, mm-hmm. but the services side went down. So net, we weren't actually buying anymore. It was just we were buying more goods and less services. We couldn't go out. We couldn't go get massages, for example.
Right. People were worried about not being able to get the goods because you remember right in the beginning of the pandemic, you couldn't get cans of food.
Right.
I mean, so people, I think people were front loading things that they thought they may need.
Yeah. So there's that. So that's the demand side. But then this is the part where Posar's article and where I see is then there's the cost push. Mm-hmm. So, and again, there's trillions of reasons why that can go up. But basically cost push means that when my cost goes up to provide that good or service to you, then I have to raise my prices. Mm-hmm. It has nothing to do with the demand side. So for example, gas prices went super high in Los Angeles. People commute an hour to work each way, and they can no longer afford to go there. Plus, daycare went up so high, so they quit.
Yeah.
Now that employer has to pay more money to replace that person, which now pushes the prices up, right? And so there's that cost push. And so I think that's the part. So now if I can pay somebody overseas $8,000 a year, but now I have to onshore that job for $50,000 a year, I'm going to have to charge more for my goods and services. Mm-hmm. So that's a cost push. And so the Fed maybe has some control. They do. He says, Jeff Snyder says they don't. I say, obviously, we can see it's happening, the reverse wealth effect. Stocks go down, real estate goes down, people want to spend less money. So they can cause something on this demand side. But what I think is possible is that while they're crushing demand, which they've stated that as their goal, mm-hmm. right? They said they're going to
demand destruction.
Demand destruction. That's all they have, right? So while they can destroy the demand, they could simultaneously destroy demand, which would bring the demand side of the inflation down, but push prices up at the same time. Right?
Yeah, no, that's absolutely possible. But you hit on the most important point, which is the Fed is trying to do something with the tools they have, and they only have so many tools, right? But
how many tools do they have?
Right, they can raise rates or lower rates.
They have the interest rates. That's
right?
One tool,
and then they can use quantitative easing or tightening. Right, which we haven't even seen them really do. So the question is, as they raise rates and asset prices and stocks and the bonds react, and real estate prices come down. Raising rates, real estate prices have to come down. It's just the nature of the mortgage, right?
I disagree.
Well, okay, let me back up.
I disagree with that.
Yeah, I know you aren't a real estate expert, but let me back up. Certain markets have gotten ahead of themselves and should come down. That's fine. There's scarcity. We laughed about this post that I made a few weeks ago about
the house. Yeah.
I mean, okay, maybe engagement farming on that. But, so the point is, though, that if you're looking at a house that was $400,000 last year, now it's $600,000, you were paying 3 and change on your interest rate. Now you're paying almost 6% or maybe even higher, and depends on the market, but and whether it's a jumbo. But that the house has to decrease in value by 50%, just the math on it, in order to have the same monthly payment, right? So unless, like you're saying, unless you have enough money supply for everyone to swallow that and continue to pay those higher prices, then the prices have to come down, right?
Or people just buy less house.
Or people buy less house.
People buy less house. So I wanted a 2,500 square foot house. Now I have to buy an 1,800 square foot house.
So what happens? Well, those houses they're still selling, but is BlackRock, are Allianz, are they going to buy those houses at those prices, or are they going to let them come in? If there's not enough demand for them, they'll let them come in. That's just the demand side, right? So,
and they have enough money to be patient and wait.
Correct.
Yeah.
So I do see housing prices coming down. I mean, it's reality. But
the question is how much, right? And
yeah,
I posted on Twitter. I said, what is when real estate's gone up 100%?
Mm-hmm.
What's a correction and what's a crash?
Well,
nobody knows the answer to that.
Well, first of all, I don't think we're going to see a crash like we did back in the housing crisis. I mean,
what would you say is the difference between a correction and a crash? When prices have gone up by 100%, a correction would seem healthy. Sure. So where's a correction and then where's a crash?
I mean, a correction,
20%.
I would say a correction would be in somewhere between the 20 and 30% range. A crash would be 30 and above. That's just personally how I may think about it.
So typically a bear market would be a 20% drawdown.
Yeah.
So
yeah.
25% is a correction. More than that, 30%, definitely more than that is a crash.
Yeah.
Okay.
But if you look at the credit,
and just to clarify that, is that from, let's say the houses were selling for 100,000, now I have to sell for 70,000? You're talking about that, like the actual price, the price of the home selling for less. Okay.
Yes,
because
yes.
what we see today is that the price appreciation is rapidly decelerating, but not actually coming down, but people are grasping onto the wrong data point there.
Right.
So, okay, keep going.
I don't know where it's going, but the point is that, the housing price, it depends on where you are, obviously. And, but the credit that has been extended to the buyers, you don't have the subprime lending that you used to have. You don't have those same instruments that were variable rates that could jump up and price people out of being able to make their monthly payments. And so I just don't see us having a crash, not like the housing crisis. Even as the Fed raises rates, even if we go deep into a recession here, I don't see housing prices crashing. There's still trillions of dollars that are reverse repoed every single day. And there's a lot of money in the system. Yeah. So it has to go somewhere.
I tend to agree with you on this, but here's another conversation to jump into where we started before. I tend to agree with you on that, but there's a lot of potential black swans out there. I mean,
that's what they call them, black swans, right?
But I mean, there's a lot. Like, I guess they're not black. These are like gray because we kind of see them.
Yeah, we kind of see them. Yeah.
And I mean, we have 3 nuclear wars potentially. We got Russia, Ukraine, U.S. Mm-hmm. We have Iran and Israel. We have China and Taiwan. I mean,
which we're pushing those buttons.
We're pushing those buttons. Japan, Germany, everyone's on board. So it's like there's 3 right there.
If you're a conspiracy theorist, you'd say, well, the United States is trying to push us into war. I mean, because that helps them pivot quickly.
So that could potentially happen. We have, potentially Japan and the EU bond markets imploding. Is the Fed going to bring all that on their balance sheet? Do the Fed want to save things? We'll talk about all those things. But so when you look at all those, there's all kinds of reasons why things could just go completely haywire.
Totally.
And I think where we were talking about before, I have this, as we always have to be aware of our own biases, right? Because those are our blind spots. I'm the eternal optimist, so that's an optimism bias for me. And I think most people, even if they're not optimists, for the last 50 years, or maybe 100 years, 80 years, we've always thought that things will get better. Like we have plenty of dips, plenty of crashes, but things will get better. The powers that be want things to improve. The Fed's going to try to re-stimulate markets at some point, right? Like, and especially over the last dozen years, we've really been trained to buy the dip, and so people keep asking, when will the Fed pivot? When will they save things? But that assumes a bias that they want to save things and they want to make things better.
Right. Yeah. And, the thing is with the Fed is they have a very tight mandate, right? And however, which we know, which is we want full employment and you want low inflation. All right. Well, good luck, because you're now in a situation where they're in such a tight spot that they can't navigate through that without causing a recession. They know that. But the thing is, look at the system. What are they driven by? It's all political, right? We're coming into midterms here. Powell decided to stay on another term, and it's ego-driven, it's politically driven, So the system is rewarding them for certain behavior. We saw today, just today, Mary Daly came out. She's the head of the Federal Reserve of San Francisco, and she said, "Well, I'm not feeling inflation at all. I'm good." Well, she makes $8,000 a week.
Yeah.
So I mean,
let them eat cake.
Let them eat cake, right? So the separation of wealth in this country and the separation of power has caused the people who are in power to be so out of touch with what is really going on out there. And honestly, I mean, we're super blessed. In America, just start there. You and I are so fortunate to be able to sit here and talk about this without worrying about our next meal. I mean, truly. And we were just talking about this before we came on the show. There are going to be a billion people who are hungry this year or starving. And are they thinking about that? You think that the Fed, chairmen are thinking about that?
No, I know they're not.
The heads? No, they're not. So, and that's the problem. It's the system. The system rewards them for certain behavior. And the closer you are to the system heads, the closer you are to the spigot, the better off you are. So the issue is you've got to change the system. And we know that, and that's why we talk about Bitcoin ad nauseum, because we know that the system is broken. And that's the problem. We're creating more and more separation of wealth in the United States, and it's becoming just like all of those Latin American countries that we used to look at in the emerging markets, where they have just a barbell of have and have nots in their countries, and we're rapidly approaching that here.
Yeah, rapidly. I just finished doing an interview on my new book release, The Uncommunist Manifesto. We've been doing this book tour. And it's the original book was the most read book on both economics and political science, and so we rewrote the book. It's not about Bitcoin.
Yeah, well done.
But it mentions the word, I think, about 10 times throughout the book. But in this interview we were just doing before, with another financial podcast, the Wiggins Sessions, he was saying how this new system that you envision of this free and open and fair system, there's really no way to achieve that in the fiat money system that we have today. And so I bring that up because of what you're saying right now. The more that you dig into these topics, the more that you dig into the topics of the Communist Manifesto, you realize that without some sort of a fair, sound money system, we'll never achieve that. And you can't draw a different conclusion. Not if you spent the time thinking about it. But you had said before we started recording that there's more uncertainty today than you think that you remember at any time before.
Yeah. Well, I mean, if you look at where we are today, my view, my perspective comes from the investment world, the financial world, but we look at just how much debt there is in the world, how much credit has been extended, and how intricate it is, how everything is interconnected. You've got Japan, who we've talked about is doing yield curve control, and they said that they will buy an unlimited number of their own Japanese treasuries and government bonds, in order to maintain that yield curve, right? So they're holding the 10-year treasury at 25 basis points, and they're buying as many as they can. Well, or that they need to. Yeah, and then throughout the day, you can see it spike to, instead of 25 basis points, to 40, almost 50 basis points, because traders and hedge funds are taking the opposite bet that they're going to have to back off that at some point. So that's one thing. The yen is suffering from it. We've seen the yen move negatively sharply in the last few months, right? And it's pushing a point where it's really hurting their own citizens. Okay, you got one thing there. Then you've got Europe. They're doing the same thing, but they're calling it a fragmentation tool, where you know, the first time they've raised rates in 11 years, and now they're just now at zero.
Yeah,
From negative
yeah.
to zero. And it's already pushing their bond market into, you can see the stresses, especially in Italy and Greece, you know, and so they had to announce that, don't worry, we're going to support Italy and Greece, and we're going to buy bonds selectively in order to be sure that their yields do not get out of control. Why does that matter? Because as yields go higher, then it costs more to borrow. Banks start having stresses in their nation, then their sovereign debt is in trouble. So it all matters. And at some point, you have the northern countries and you have Germany who they're going to balk. The citizens are not going to want to pay for that anymore, right? They're going to demand austerity. They're going to demand something, right? So at the same time, you've got energy prices obviously going through the roof in Europe, and you've got geopolitical forces that are going to cause those to stay high, and they don't have the supply. They have the supply issue where they cannot support themselves. They have to absolutely buy from Russia. And then you go all the way around the other side of the world, and you've got China, who has this housing crisis that's brewing, right? So you have citizens that don't want to pay for the houses they put their down payment on, and the government's trying to swoop in and force them to. They're seizing bank accounts. They're like, that's another. So you can see how it's all swirling around, and then the U.S. dollar is just swallowing all of that, the pressure coming from the other currencies. Why? The Fed is raising rates. If you just look at interest rate parity, if you're looking for yield and you look for a flight to safety, then you come to the United States. You buy dollars, buy treasuries, right? So, and at some point, the stress just gets too big, and it causes a crack. And I don't know if it's in Japan, if it's in China, if it's in Europe, but at some point something breaks, and we're pushing right up against that. So the uncertainty is, well, we're all, the fiat system, which is, you've done research on that, you've talked about it quite a bit, where this is an experiment that's not been going on for very long. So everybody who's alive right now is thinking, you know, well, I mean, this is the way it's always been, you know.
Here's a good analogy. By the way, for everybody paying attention, and for you, I'm making notes. Don't forget to come back to. I'm not texting people. I've got all these hateful comments. What are you doing texting on this interview? It's so rude. But I don't want to interrupt you, so I make notes to come back to. But a good analogy is we're pushing right up against the edge of something about to be broke. We don't know what's going to break, but we know something's going to break. And I was just thinking back to the new Top Gun movie, which by this time I'm sure everybody has seen, was one of the best movies I've seen in a long time.
Awesome.
First movie I've seen where I didn't feel like propaganda was being like shoved down my throat, and I could just like watch it. But in the beginning, he went out to he was testing that plane. He was like trying to get to a certain speed or whatever, and like they were trying to shut down the program, and he's like, I'm gonna go out and break the record or whatever, and like he was pushing up against it, and they're like, okay, you broke it, back off, but he wouldn't, and like the whole thing's like warning, right, and like the whole thing was about to break apart, right, and it was like back off, and he's like nope, and he just like keep the pedal to the metal, back up, and then something broke, and I feel like that's kind of where we're at today. Exactly. We see what's happening. We know it's inevitable. And like, if they would just back off, but the problem is they've gone too far.
They already did.
And there is no backing off. So is the engine going to go out, or is the windshield going to crack, or is the wing going to rip off? Like, we don't know, but something's about to go.
Or even more scary is that there may have already, back to your black swan, there may have already been something that's broken that we aren't seeing yet. And so the forces are too strong to reverse it. And so that's what worries me, is that, look, it's simple math. You talk to Greg Foss about this.
Yeah.
It's simple math. If your debt to GDP globally is 3.5 to 1 or 4 to 1, the math doesn't work.
Yeah, you don't grow out of it.
Yeah, you can't grow out of it.
The Japan thing, that's a big deal. I mean, at some point that's going to break sooner than later. I think once they pivot off of that 25 basis point peg that they've identified,
Yeah.
once they back off and go, okay, we'll go to 0.5 or we'll go to 1, once they back off once, then it's game over. Then everybody knows they're going to come off of that. It's a problem. But the European one seems even bigger to me, because to the point you're making about this fragmentation tool, I recently had Macro Alf on, maybe editor. We can link up to that interview
Super
here.
smart, yeah.
And we talked about that fragmentation piece. And the thing with the fragmentation piece is it really kind of is the perfect example of what's going on with this fiat money system, where what they've done is they've cobbled together all these independent nations, and the PIGS nations, the Italy, Greece, Portugal, Spain, etc., they're not pulling their weight. They can't survive. And so they have to constantly get bailed out. We've seen that in 2016 and with Greece and their austerity and all that stuff. But even today, they still can't pull their weight. And so Germany has been that engine that keeps pulling them forward. But now now Germany is falling behind. Now Germany is a net importer. The energy policies.
I was going to say, they just flipped to be a net importer for the first time ever, right?
Yeah. So now the engine is broken that's been dragging them all forward. And the reason why I think that's important is this fragmentation tool. In order to save things, in order to make things more equal, we have to make things less fair.
We have to fragment.
That's the trade-off.
Yeah.
Equality or fairness. In order to get more equality, we have to have more unfairness. The more fair we are, the less equal we are, right? And so what we want to do is we're going to go steal the wealth from the producers and the savers, and we'll give it to we're going to take all the grades from the A students who spend all weekend studying, and we're going to give some of those scores to the people that go out and party at the frat parties every weekend. And that doesn't last very long. And so this fragmentation tool, to me, seems like the beginning of the end. There's just no way they're going to continue doing that.
It's a really bad idea.
Especially when they're getting squeezed now with the whole NATO situation and the need for energy. So now Germany's like, well, shoot, we need energy. We have to buy it. And you're taking all our wealth and giving to these people, which we don't like. And Putin says that if we stay in NATO, he's going to cut us off, and we already kind of want to leave anyway. So maybe we should just leave, right? And like you start having all these different scenarios that play out.
Yeah. Well, I mean, there'll be at some point it'll be forced to break up, and that's just the reality. And that, last year, late last year, early this year, I thought, well, Japan is the one that's really they're the ones who are driving toward a problem fast. But Europe, I mean, they've taken kind of the front seat here.
Yeah,
it's an issue.
Yeah, and they're both happening at the same time, and then you add the war on top of it. So now Japan is 100% in on this war with Taiwan, supposedly, and then you got Germany now is pledged to be on the war with Taiwan, but now at the same time they're also dealing with the rest of the situation. So,
right, it's almost like they're all joining in forces to have the excuse to print more and just kick that can down the road. Because remember, all they care about is like you said early in the conversation, is that they care about their own reward, and the system rewards them for being reelected and giving them power and giving them money. It's not that they're, if you talk to Jeff Booth, he'll say, look, it's not about them being evil. It's not about being bad people. It's about the system rewarding them for that behavior. So are we really going to start a world war? Well, I mean, if it somehow staves off that the collapse of multiple currencies, I mean, I could see them doing it. I'm not a conspiracy theorist, but
we're always trying to understand incentives, because incentives, show me the incentive, I show you the outcome, so to speak. And so if that's what they're being incentivized to do, then most likely that's where they're going to go, right? We all work off incentives, which, of course, Keynesians and Marxists don't somehow believe or see incentives. They think that we're all just digits on a spreadsheet, but they don't take into motivations and incentives.
Right.
So jumping into motivations and incentives, let's bring it back to the United States.
Yeah.
And for anybody listening internationally, this matters to you because, of course, the dollar is the reserve currency of the world, and the Fed still drives that. So the Fed, they have been November of last year. They said they're going to raise rates, and the markets, the risk on assets started selling off pretty quickly. The Nasdaq and Bitcoin crypto made its all-time high in November and has since selling off since. S&P didn't start selling off till January. They got really aggressive. They started raising rates. Not as aggressive as many of these Paul Volcker-ish fans wish they would be, but pretty aggressive. The markets have sold off pretty heavily. And now the economy is crashing. Now we have the White House press secretary coming out and telling us that it's not a recession, right? We don't have 2 GDPs of negative growth. And she said that the economy is historically strong.
Yeah. Well, again, it's all framing because we have midterms coming up, right? So that's the most important thing.
Is the economy historically strong?
I don't feel like today it is.
Well, do you feel it or do you see it in the data?
No, I see it in the data that is not. So the problem is that, well, first of all, the Fed looks back at data that's old, right? And they're reactionary. Powell even said it in, I think, 2 conferences ago. He said, we are reactionary. We react to the data. We do the best we can. Okay, well.
Do you really believe that, though? I mean, they have, 450 PhDs. They have 1,000 researchers working for them. Mm-hmm. Are they really, like, we're looking at leading indicator data and they're not?
No, I think that they have to act on data that they can pin, their that our trust to, which they've lost our trust already. But so that's number one, is that they're reactionary to the data, and the data it's stale. So that's the first thing. But if you look around and you see the housing prices come down, the asset prices come down, people are the employment numbers, the amount of growth in wages, just the cost of goods is squeezing people. The cost of gas, is squeezing people. No, the economy's not as strong as it was historically, for sure.
Well, the Biden administration came out yesterday patting themselves on the back. Gas prices are down 80 cents.
Yeah, from a high that he created, right?
They
create, or this system or this administration, whatever you want to call it, created, right? So.
And then they tout this unemployment number. Mm-hmm. Which is historically low, but they don't talk about the labor participation rate being at one of its lowest levels.
Right. So you pull people out of the employment pool, and obviously the math works out to be a lower inflation rate. So, and how many jobs are filled by people who are working 2 and 3 jobs? I don't know.
Well, I don't know. That's a big piece of it. And the amount of hours they're working. And so we see the average workers down to like 30 hours a week. So not even at full-time employment. So that's a problem as well. So we see that is bad. And then maybe some of the forward-leaning data that they can't lean on, but I look at is extensive polls that have been done. 55% of businesses think they'll be forced to shut down over the next 12 months. 65% of all businesses in the transportation sector are behind on their leases. 35% of all small businesses are behind on their monthly payments and leases. So
look at the consumer confidence numbers.
The consumer confidence is through the floor. And then we've seen all the big Fortune 500 companies announcing massive layoffs. Thousands and thousands of people at a time. And
all of the major tech companies have said, we're not hiring freeze at the least.
So we've seen everyone announce hiring freezes at the least, massive layoffs also. And that's forward leaning, meaning that hasn't shown up in the data yet, but they've just announced they're going to lay the people off. We know those people get laid off. We know they'll file for unemployment, and then we'll see it reflected in those numbers. And so that's why it's like, how can they not look at that data? They got to look at that data.
They have to look at the data, but you remember they're leaning really hard on data, the unemployment number that they get, that they can publish and say, this is what we're making our decision off of. It's all cover your ass, right? I mean, like, they've got it. They can't make a decision on something that they think is happening. They've got to make a decision, or they've got to declare they've made their decision on what they are seeing in data they can publish, they can present. So the second thing is the CPI. Well, we were talking about the housing numbers coming down. Well, they haven't come down enough for the CPI print to come down substantially enough to get closer to that 2% rate that they're targeting, right?
They
So-
won't. I don't think housing is going to come down at all for CPI, Brent.
Well, and that's 30% of CPI, right? So it's a major contributing factor.
But the
or the equivalent, the housing equivalent now that we're using.
It's
right?
the housing equivalent.
Right.
So that's the key piece. And there's a big discrepancy I posted on Twitter yesterday about this because it's a homeowner's equivalent. So it's not the price of the home. The price of your home went from 500 to 700,000, but they do a poll.
Yeah.
And they ask homeowners, what do they think they could rent their house out for? Now, I don't know where they get that data from. They've never asked me. But what we can see is that rents vary greatly across the country. So they showed, I think, a 5% increase in shelter or something like that. But per rent.com, I posted it on Twitter yesterday, the average nationwide rent increase was 26.8%. That's the average, with many areas going up over 100% and some actually going negative. Some went negative, some went up 100%. So the national average. So I don't know where they get the 5%. The national average was 26%. But what's happening also is that what we're seeing is, because rents are typically leased 1 year, 2 years, et cetera, not until you get that person out do you really get to mark it up. So now I can mark it up by $400 a month or $600 a month. And so we're really starting to see that coming on. And so while home prices could drop, so maybe it is going to go from 500,000 to 450 or whatever, 400, I think we're just starting to see these rent increases coming through.
Another lagging indicator.
Yeah.
So, and that's the problem, is that they're looking at this data. And so I don't think that, and we talked about it this morning, you, Greg, and I were kind of batting around on something I posted that, hey, look, the Fed can and will raise again from what I see, because you have the Fed staring at numbers that they've got 2 CPI prints and 2 unemployment releases between now and the next meeting, right, in September. So unless this CPI print is drastically lower,
What would you say drastically is?
well, I mean, it would have to be down in the 4.5% to 5.5% range in my mind.
So you have to go down by 50%?
Yeah, they would have to go down quite a bit for them to say, okay, we're getting there, So otherwise, their foot is on the brake, right?
I think he said
if it comes down to 6.5%, what do you think he's going to say? Okay, well, it's starting to come down, but they've also come out to clarify his comments. You've had multiple Fed governors come out to clarify his comments, which are, hey, look, we need to see a sustained slowing.
Meaningful. They use the word
Meaningful and sustained. So that's not one print; it's multiple prints.
Right.
So,
but I think if we went from 9.1 back to 8.5 to 7.8 to I think that's meaningful and sustained.
But does that make them stop?
I think so.
If it comes down to 8.5, you think it makes them stop? I don't think it does.
I think they could pause, wait and see.
Maybe.
Yeah,
maybe. Because the problem is.
Do you know what the dot plot projects for them right now, or I haven't looked at the betting markets. The betting markets are pretty good about showing where. I haven't looked at it.
It's somewhere around 3.5%, I think.
Is where they think they'll end.
Yeah, that's the terminal rate.
So they think there's like a half a point in front of. What are they?
Another full point.
Another full point. Yeah.
So, but I do think that we do get that sustained. Okay. I'm not a bear, by any means. I think they will pivot. It's a question of when.
Sure.
So I absolutely believe they will pivot. They have to. It's a question of when. They don't want to they can't break the market. And so I think it's going to be, they'll pause, hit the timeout somewhere around the election. It makes sense, right? Somewhere around November, they're going to hit the pause button, declare victory, and say, okay, now we're just going to step back.
Which would be one more raise, basically.
Which would be one more raise, right? So, but the market is not expecting a raise. The market has basically said, okay, we're done. And I don't think that the Fed is ready to say we're done. And so that's where I'm a little bit different in my view from some people. And I just don't think the Fed thinks that we're done yet. But hey, look, if this CPI print does come down to 5.5%, 6%, maybe they do say, okay, now it's really decreasing. It's decreased by 30%, that would be, maybe that would be enough.
I do want to point out to everybody listening, I always like to clarify this. If we get the CPI print from 9.1 to 6.5, hooray, congratulations. That doesn't mean prices have gotten cheaper.
Thank you.
That doesn't mean things come down. What that means is they're still going up at a crazy rate, just not quite as high as as fast as they were before.
It means that's right. So, and that's the problem, is that it feeds on itself. It compounds. And, the price of goods that are in the grocery store today, they're not coming back down. It's not like you're going to go back to, milk is going to go down by 40%. It's not. It's where it is. It's just a question of how much does it inflate in the future. Now, remember, like we talked about quite a bit, is that inflation is necessary for the Fed to be able to pay off debts that are rolling off. They have to inflate it away.
And that's back to the Austrian view of inflating away, meaning increasing the money supply.
Right, and which exactly. So, and will it work for a little while? But at some point, it breaks.
Yeah. When you say it breaks, what do you think they're watching to break first? So I think you've already kind of made the case, and I would agree if this is the case you're making. Correct me if I'm wrong, but they don't really care about the economy or the markets. Mm-mm. They care about the full employment and the stable prices. And those are kind of at odds against each other, but the stable prices, so the inflation is their big target. So, damn the economy and the markets, we need to get inflation back under control. But when they're looking at something breaking, to your point, is that the credit markets?
Credit markets.
The credit markets. So they need to make sure liquidity stays in the system.
Yeah, because, once the high yield spreads go to a certain point and it becomes very difficult for companies to borrow, then you start seeing companies fail. Mm-hmm. Right. And I do think we're still behind the curve on that. We're going to see some of that happen.
And if companies fail, then we have too much demand destruction, and then the stable employment starts falling off a cliff.
Yes, exactly. So recession, it nears depression. So I don't think we're going to get into depression. I think they're going to hit the brakes pretty hard before that, and they will pivot. But that's that. Okay. After this round of QE that we're done, and now you have this little bit of QT. Whether or not they ever roll anything off of the balance sheet remains to be seen. But that's the other thing, is if you roll $2 trillion off the balance sheet, that's the equivalent of another. It's about a 0.25%, I think, per $500 billion of quantitative tightening. So think about that. If they start really rolling some of this off of the balance sheet, that has the same effect, just muted, right? So there's that. But at some point they pivot, and we need some liquidity injected back into the system. We have inflation, grow the money supply, and you get to the point where the next round of QE is so substantial that the confidence begins to falter. And so it won't be in the United States first. I think the United States will be the last. But you will have countries. You'll have Japan. You will have the European Union. You'll have major countries fail, whether it's Canada or other nations that will push up against the edge. They'll fail in this next round. So I think we've kind of done the last round in this fiat experiment. So
do you think the Fed wants that?
They want for
other currencies and nations to fail?
No, I don't think they particularly want it. I don't know how much they care. I don't know, but they don't. I don't think they particularly want a dollar milkshake. You
don't think they want that? Mm-mm. So a common argument against cryptocurrencies and Bitcoin would be that the central bankers would never allow something to challenge that and take away their power, like Bitcoin, right? And I agree. That's of course right. F.A. Hayek said there should never be a sound money again until the thing is taken from the hands of the government, but it can't be done by force, because they're always going to fight it, and you can't fight it. And if that's the case, which we both agree it is, I think most people would.
It sounds like you think that they might want it.
Well, then does the Fed want to cede control to the ECB?
Of course not. Yeah. But I don't think there's a danger of that.
Okay,
know?
so there's no danger of any other currencies taking the power off of the dollar, because it sure seems like a lot of people in government think that's the case. We've seen many politicians, Brad Sherman from California, one of them grandstanding on that. We have to maintain, even Elizabeth Warren, we have to maintain the dollar's dominance. Is what
And
allows
reserve
us
status. Sure.
reserve status allows us. That's what allows us to do sanctions and all these things. And so
Control. Right.
control, right? So wouldn't the Fed, I mean, we've seen the Fed, or we should say, we've seen the dollar losing its place as the reserve status for quite some time, and it's falling from 70% to 60% to, I believe sub 60 at this point. And so at some point, wouldn't they want to like, well, shoot, we better stand this back up again?
Well, I don't think they have to do much for that, for the dollar to regain quite a bit of that dominance. As we see Western nations, we will see them fail, and Latin American countries fail, and they will roll into the U.S. dollar more or less through the Brent's milkshake theory, just through liquidity. And
Which is what's happening now, right? So we have a dollar shortage on our hands. All these nations want to move into the dollar, and they want to buy the treasuries.
have to,
But in order to buy that, they need the dollars.
Right. So, and the dollar milkshake theory, for those, Brent Johnson from Santiago Capital came up with this, I guess it's an analogy, but he said, it's like you're sitting there, right, all the way across the table, and you have your milkshake, and I have a really long straw. And so I can plunk my straw into your milkshake and drink it. Well, that's your currency. I'm the U.S. dollar, and that straw is all the liquidity needs. All of the U.S. dollar denominated debt, the U.S. dollar denominated liabilities, the difference in foreign exchange rates. So for countries or sovereigns or individuals or investors who are looking for higher yield, they'll go right through that straw into the U.S. dollar, and it's exactly what you're talking about. So it's going to happen. It is. I think we're seeing it kind of happen in slow motion here, and I think it's going to happen over the course of this next round of QE, where it happens rapidly for a number of nations. The problem is for the U.S. is that it's not just Bitcoin, but we've had a little bit of a wake-up call that, it kind of matters to have hard assets and commodities in your nation to back your currency with.
Yeah, energy,
it matters.
Yeah.
So, so that's I think it's around the corner. I don't think it's right up against us, but maybe, I don't know. What do you think? You and I have talked about this before. You thought that this might be it.
I thought that there's a chance to the framing that I asked you that question, in that the Fed wanted to kind of re-exert its dominance, and so kind of drain some of the liquidity out of other currencies. We've seen this happening at a meeting in June of 21. Jay Powell and Christine Lagarde of the IMF had met and said, and ECB, previously with the IMF, now with ECB, and had said, hey, we're not doing this woke stuff, we're not doing this green stuff, we're not going to print $100 trillion for you to do this, like, good luck with that. And so that was kind of like this separation of alignment, because the East, you have the different camps. You have like the ECB, which would also include the WEF, Davos, ECB, and even put the Obama-Biden administration in that camp. And so they have this massive agenda to reindustrialize the world and transition the energy and spend I think it's up to like $173 trillion to do that now. And I think the Fed's like, look, that's not our mandate. We're not mandating to like print $100 trillion to transition. Ours are, back to we said, like stable employment and stable prices and full employment. So he said, we're out. Like, good luck with that. And then it was the words, but then it was the action. So the next day is when they started to raise the rates. The very next day after that meeting, started raising the reverse repo rate, and it started draining liquidity out of the ECB. And so to the point, they've really put these nations in a rock and a hard place. I guess it doesn't really matter so much why. Yeah. And so I think that's one thing. But I think at the other end, like, the Fed doesn't necessarily need to do that. These other currencies have already destroyed themselves. Yeah. And so I think maybe I would probably agree with you in a sense where you said that that's maybe not what they want, but they don't care if it happens.
They're not actively stopping it, right?
They don't need to. Like, they can see they're on their way out, and they're not going to pivot off their decision to save them. I don't know. I guess that's where I'm at. Now, I think the Obama, Biden, White House, along with the ECB, Davos, Euro group, would probably like the Fed, and this is where I see the Fed and the Biden White House are really kind of starting to break apart. I think those are two different factions. I think the Fed doesn't care about what the globalists want. They really care about the dollar and what their mandates are.
I agree. And if you want to assert control, the easiest thing to do in the short term is to institute a CBDC. Instituting a CBDC, that we've talked about it, and that is exactly where they want to go. Elizabeth Warren, she wants a CBDC. She doesn't want Bitcoin. She wants the ability to determine exactly what goes into your bank account, when it goes into your bank account, what you can spend it on, when it expires. That's what they want. That gives them ultimate control, right?
Do you think that, so there's the control side, but the problem that we are facing today, or we're seeing in other nations, is that it's the fiat money printing. And so they've created way too much money. They've had to drive interest rates all the way down to keep propping this bubble up. And so that's the proverbial rock in the hard place, right? So either the markets crash or they keep pumping them up and then inflation goes sky high.
They need negative real rates.
They need negative. That's the financial repression. But in order to keep everything from crumbling down, to keep the businesses from going out of business and people losing their jobs, then they have to keep pumping money into the system. But as they keep pumping money into the system, then inflation keeps raging. And so that's the proverbial rock and hard place. Right. So do CBDCs help that?
No, it just helps them control down to the individual how much liquidity gets into the system, where and how, right? So if they're worried about food prices, then they could put controls on where you could spend your money, and you can spend it on energy, but not food. You can spend it on gas, but you can't spend it at the grocery store. You can't spend it in a restaurant, so they can put controls that go dial right down into the daily life of anybody they hand that money to. And again, it goes right down to if they're going to have a stimulus check, it goes directly into your account from the Fed, and they have every single control parameter on that. So
it's a lot more targeted. So for example, this low income family, they're a commuter, they're spending way too much on gas. Let's give them money that's programmed where they can only spend it on gas.
Right. Or say, you can only spend it on this much of gas, so start doing a ride share. So you have to come up with a way to go to work with somebody else,
And by doing some measures like that will help this proverbial rock in a hard place.
No, I just think that's what they want. They think they think
it'll help them.
Correct. That's what they think that having that control and their algorithms will help them. Of course it won't. The problem is
what they think is that central planning always fails because it doesn't have enough data. So a group of people in DC have no idea what I want here in California, right? And so it always fails to have enough data. But if they can get all this data, then they think they could manage it better. Right. So I get that, but do they think it gets them out of this proverbial rock in a hard place? Because it seems like it's inevitable.
No. I think it's just a defensive measure against something like Bitcoin.
Yeah. So then if that's not going to help them get through this transition, which seems like it's inevitable, I know a lot of people maybe watching this are like, well, I've been hearing this for 50 years. Well, for 50 years, we got the gold standard 50 years ago. For 50 years, we've been getting closer and closer and closer and closer. As Luke Gromen,
that cliff's edge. Yeah.
As Luke Gromen says, we see the signposts.
Yeah.
We see the signs. We're getting closer. We don't know exactly how long it takes the distance to each one of those signs. But it has been happening for the last 50 years, and we're getting there. So if it doesn't help them out of this situation, then what? Then reset?
Reset. Maybe there's no other way unless we somehow get enough leaders who understand and believe in using Bitcoin, for instance, as a reserve asset. There's no other way to ground this currency. It's a fiat currency that is literally floating away, and there's no way to ground it. You can't ground it with gold. And gold is
why can't you ground it with gold?
It's way too manipulated with paper markets. You just can't do it. So I don't see a way for them to do that, to go back to the gold standard. So,
what about people that say Bitcoin's manipulated?
Well, it is, but not nearly as much as gold, and maybe it would be if we allowed it to, if we allowed all the paper markets to be built on top of it like gold has. But
The big difference I see with that is that gold is very opaque. So there's a couple things. One, taking possession of gold is very difficult. And so, like, if I want an ounce, that's easy. I can put an ounce in my pocket. But if you're
proving it,
but if you're a sovereign and you need, $100 billion worth of gold, how do you take delivery of that? It's very difficult. Proving it to be good gold, right? China was found with all this fake gold. That's a problem. But then the audibility, the provingness of it, to your point, the validation. But that's the validation of is it real gold? But how much gold is there? How many paper contracts are there versus the physical? We don't really have any visibility to that. Whereas with Bitcoin, we have on-chain data. So we'll always know exactly how much Bitcoin there is. We'll know exactly where it is, and we'll always know how much paper is on top of it. And so one, that transparency, I think, will really hurt their ability to be able to manipulate it as much. And then two, because of the ability to just custody it myself, then a lot of what I think sets that paper market up is like the ETFs and stuff that we have. And so we don't need ETFs if I can just buy it directly.
Right. Agreed. And ETFs, they could help adoption of Bitcoin and get and spread the adoption through the smaller institutional world pretty rapidly. Look, if you're an individual, this is the first time where you have the ability to step into something before the institutions do. When I was on the, working in a hedge fund in the late 90s, early 2000s, we would scramble all over each other to try to get these shares of the IPOs, the hot IPO shares, right?
Sure.
And anything you could do to get JP Morgan or Morgan Stanley or Goldman to give you just a few shares of this thing called Google, you would do anything, we're gonna do more trades with you, whatever we need to do, and they might give you 1,000 or 2,000 shares of this. You would ask for 100,000, you'd ask for 1 million, and they would give you a few thousand shares. Well, we got those shares at the IPO price, completely legal, but that's what it was. You got the shares at the IPO price. And then you were able to go into the market the next day and it was up 100, 200% in an instant. And that's where the retail buyers bought it. The people, the mom and pops, the individuals, that's where they bought it. Okay, so you have the exact opposite that's going on right now with Bitcoin, where institutions, it's not easy for them to get into Bitcoin. And, it's hard to understand if you haven't sat in one of these institutions, but they have to go through so many steps to get it approved to be a separate managed asset or to be added to the portfolio, because it's so different. It's not regulated like other assets are, right? So the problem is they have to go through meetings and approvals and meetings and approvals, and they have to come up with compliance measures. They have to decide who's going to settle, how it's going to settle, who's going to custody it. Like, there's just so much that has to happen. It takes months and months and months. But if you're an individual, you can go out and buy Bitcoin today and have it in your wallet before the institution even has their first meeting. And that's the difference. So an ETF will help those institutions get there and help. It'll help their investors. Remember, they're managing investments for individuals. These are pension funds, they're endowments, but they're primarily pension funds who are managing assets for individuals. And so those individuals get that benefit. That will help Bitcoin get to a status of a stable value, a store of value. Once it gets enough market value, that will allow it to get to the stable value where it becomes much more tradable. It becomes a much safer, and the volatility will drop. And at that point, that's where the adoption curve, I think, really takes off. So, if that makes sense.
I look at I've made many videos about talking about how Bitcoin isn't just a new technology; it's a technological revolution, and it's difficult to understand because it's a lot of things today, and it's going to be a lot more things in the future we don't know. But I look at it as it's a new set of building blocks that allows us to build new things on top of. So, for example, we've had 5 technological revolutions, one of which was steel. Steel, what is this? Well, it's a harder metal. Okay, well, what do we do with it? Well, it allows us to build things we couldn't build before, like skyscrapers and bridges. Okay, right. So it was a new set of building blocks that now we have spaceships because we have steel. Right. They didn't know that at the time. Or electricity. Well, what is it? It's like a digital candle. Okay, but it's a building block. What can we do with electricity? Well, we could do something like we're doing right now. We have lights, right? And so Bitcoin is digital cash, it's digital gold, and it's all those things today. But it's also a set of building blocks we can build all new types of things off of. One good example is Jack Dorsey's new company. They're working on those DIDs, decentralized identifiers, and they use the Bitcoin blockchain to hash into the secure ID. And so without the time chain, the Bitcoin time chain, they wouldn't have that to now build off of.
Right.
Okay, so if we have a new set of building blocks, we can build all different types of things off of. Like I've just given that example. How do you see the space shaping up in the future, as far as being built on like an industry or like a category, right? So like, sure, right now we have some exchanges where you can go exchange your fiat currency for Bitcoin. Some exchanges you can exchange your Bitcoin for other assets, whatever. But do you see lots of other types of things being built on these new set of building blocks? And if so, how does that get funded? I mean, are venture capitalists going to have to kind of start to recognize that and then move into that category?
Yeah, I mean, you can think about any financial industry that could be applied to it, right? So, and just think about mortgages, right? Or lending, like having asset-based lending that is you actually can have verification of where those assets are, and you don't have this problem of fractional lending where you lending upon lending upon lending upon lending, because you can verify exactly where they are in some sort of escrow account. And of course that can all be built on that. How does it get funded? Sure, venture capital is super important. And as these fledgling companies, they have their ideas, they have this whatever they're working on, they need a little bit of money to get going. And just like any technology, and even though it's not just a technology, but just like any other technology, you need to do some sort of research and proof of concept and all of that, and sometimes it takes a few million, sometimes it takes tens of millions. It depends on how big the project is. Obviously, that you've done a ton of investing.
Yeah, I have. I asked that question more specifically because of the plebs, the so-called Bitcoin plebs, and they're so hardcore in this vision of wanting this Bitcoin world where Bitcoin becomes dominant and everything's based off of Bitcoin and we're on a Bitcoin standard. But in order to get there, we're going to need to develop that world.
Absolutely.
That world has to be built. And so
it's going to take a massive amount of investment.
Right. But they're like, oh, we're only going to buy Bitcoin and we're never going to do anything other than just buy Bitcoin. But it's like, well, how do you expect to have this world unless people invest into that world and build that world out? Yeah. So it's like the world they want is like geometrically or diametrically opposed to the...
It's almost, well, I think they're just making a leap without having that bridge to get there, right?
So it's just a misunderstanding of how things actually get built out.
Yeah, I mean, it's a simple misunderstanding of or just not being exposed to how these things actually happen. How, a Google doesn't just happen in somebody's garage, you can start there, but you need a lot of investment, to get something like that to actually grow and expand properly. And so, we're going to need trillions of dollars coming to this space, many trillions.
Yeah.
And I do see a lot of interest in institutional investing in so how is this going to work, and what does it really do beyond just this initial conversation of, oh, Bitcoin is digital gold.
Yeah. It reminds me a lot of what I see in the ESG space today, where you have all these people coming on board and saying, yeah, we need to reduce our reliance on fossil fuels, and we need to reduce our energy usage. But do you understand it's through the energy uses that you're able to have this world that you have, right? Or you have this really rich guy from New York who takes his private helicopter to Wyoming, and he's on this 1,000-acre ranch, and he looks out and he goes, "This is so amazing. The whole world should stay pristine and untouched, just like this," not realizing what went into his ability to have that wealth and get on the helicopter and go there. And I think that's kind of maybe the same mentality I see with a lot of plebs today, where they're like, "I'm just going to buy Bitcoin, and why would I ever invest in any Bitcoin type companies?" But not realizing that the world that they want to live in is going to take investment. And unfortunately, some people are going to have to take that risk. Hopefully there's a reward, and there's a whole nother conversation we could have based off of that risk reward profile. But in order to get that world, to your point, it's going to take trillions of dollars to get invested, and the money has to come from somewhere. And so I like to have a philosophy for myself is invest in the world that I want.
Yes.
Right. Help that come to fruition.
Yeah. And you can invest your time, you can invest your money, you can introduce people to each other, you can network, help people network, and all those things are incredibly important for new ideas to come to fruition. And I've seen plenty of great ideas die on the vine just because they just didn't have enough momentum, enough people, enough money, and enough energy go into them to get them going. And Bitcoin, I think, I do believe it's ultimately, it's going to happen. Just I don't know if it's going to happen in my lifetime that we get on a Bitcoin standard, but ultimately we get there. That's my belief. And maybe it's like you said earlier in the conversation, because I'm an optimist and I want the world to be better. I want these problems to be fixed. I want the fiat issues to be fixed. But just because people who are currently in that fiat system, that old traditional financial system, just because they're coming over doesn't mean that it's going to change that trajectory. I just think it can accelerate it as long as you get them to believe and really understand it. And that's where the big leaps are going to be made, where you have these super powerful people or super wealthy people who get it and they understand it, and that's going to be the big leap. It's not about it's not about being an investment and making money on it. It's about understanding really what the proposition is here and why this system will make the world better.
Yeah. I think we'll wrap it up with that. I think the taking thought I have that seems to kind of go throughout this whole conversation and really wraps up with what the part you're talking about there, and something I've been talking a lot about recently with my book release on Communist Manifesto, is
congratulations, by the way.
Yeah, thank you. Awesome
book.
Is people needing to think past first order. People needing to look past the headline. People needing to spend a little bit of time to do a little bit of research and think through these things. And if you can't spend the time to just think through this a little bit, you're never going to make it. And so when it comes to thinking through this economy, as we talked about, or back to investing through Bitcoin, you're going to have to spend the time in investment in yourself, on your own education, and it pays off in spades.
Absolutely.
Anything else we didn't talk about that you want to bring up?
No, I think it's great. I appreciate you having me on here.
Gone deep.
I like your town here. It's awesome.
Thank you. Don't dox it, but I know you've been recently writing quite a bit on your Substack, so we'll definitely give a link to that down below for everyone to check out. Of course, follow you on Twitter, where you're getting to be more and more active. And you're probably starting to realize it's a big suck on your time, and you're going to try to figure that out like I am.
It's a lot of time.
At James Lavish, we'll link that down below as well.
Right, awesome.
With that, we'll sign it off.
Thank you. All right. Thank you, Mark.
All right, thanks.
All right.
All right, that's a wrap. Thanks for listening to this conversation we did with James Lavish. It was a great conversation. I love doing them in studio. Hopefully that was entertaining for you and informative. We've covered a lot of ground. I'd love to know what you think about it. So, of course, as always, leave me a comment. Let me know what you think. Ask any questions that you have. I'd love to be more interactive with you if you have questions about any of this. And, of course, for the algorithm, of course, hit that thumbs up button if you like the video. If you don't, that's okay. Hit the thumbs down, but at least tell me why. And while you're at it, hit that subscribe button and the bell notification so you know when I put new videos out. And that's what I got for today. All right, to your success. I'm out. Since you've stayed to the end, I know you like this video, which means you're probably going to really like this video right here and this video right here.